Good afternoon, everyone. This is Edward Talisse for Chelsea Global Advisors and the CQF Institute. I'm sitting here in New York City on October the 14th, 2014. The last several weeks, and indeed the last month, have proved to be very painful for holders of risky assets, particularly holders of equity securities in the United States, Europe, and even in Japan. The last 30 days trading has seen headline indices retreat by anywhere from 5 to 9% across the globe. The retreat of that magnitude, although worrying and potentially very painful, particularly if you need to sell and you need to raise cash, is not all that impressive when you look at a very long time series of the biggest monthly losses that equity markets have had over the past 40 years. For those that are old or older, certainly people of my age will remember October 1987, where a monthly decline of around 22% happened in a single month. The market actually went on that year to close about 2% in positive territory. Given the recent price action, what I thought I'd do today is to point out what I call the Skew adjusted mean variance framework. It's a framework that's designed to help investors and traders pick their way through the upcoming landscape over the next couple of months to ensure that they can protect their portfolios from further deep losses or to benefit if the markets do recover and capture some of the upside. The mean variance framework has been around for many, many years and indeed is taught in all the business schools and universities and is practiced by most sell-side institutions on Wall Street. So what I've done here is I created a simple data table. And please note that the data is not necessarily 100% accurate. Some of these amounts are my own estimations about expected volatility and expected return for the various asset classes. So I start with cash, which of course has an expected variance and expected return of 0, and go through the various highly liquid, highly traded asset classes like the S&P, large cap stocks, small cap stocks, bonds, some commodities and high yields, and I end with base metals. For each of those asset classes, I come up with what I consider to be the base case, expected return, the bull case, and the bear case. I think for a base case to be the standard or the beginning spot, you have to assign at least a 50% probability that that base case comes out. Otherwise, it really doesn't make sense to equally weight the bull case, the base case, and the bear case equally. So how do we do that? Well, I've come up with something that I think you won't find someplace else, which is that we look at risk reversals and the implied skew that's based on these risk reversals in the market. So for example, I'm taking a 25 delta S&P risk reversal that is quoted at 5%. Again, please remember that the 5% is not necessarily market-based. This is my estimation of where current risk reversals trade. So for the typical risk reversal in the market for S&P options, the implied volatility on the puts exceeds the implied volatility on the calls by about 5%. And indeed, if you trade or an active equity option investor, you'll note that risk reversals tend to be quoted by the vol skew. So in this example, I'm assuming that the vol skew is 5%, again meaning that the vol on the put side is more expensive than the vol on the bull side, on the call side, excuse me. So what I then do is I simply weight the bear case 5% greater than the bull case. And I think this is not only intuitively appealing, but it also is grounded in observable and tradable quantities, since you can go into the market and trade these puts and calls. So in order to come up with the chart on the right-hand side of the page, I have weighted the base case at 50%, the bull case at 5% below the bear case to come up with these 4 quadrants on the expected mean and variance framework. Ideally, investors want to end up in quadrant 2, where expected return is pretty high given expected variance. However, in today's environment, it's extremely difficult to find investments that offer high expected returns with low mean variance. I think most investors find themselves today reaching for yield since interest rates are so low, and they tend to end up in quadrant 1, which I call swinging for the fences. I'll leave you with the thought that I think quadrant 3, although optically does not seem that dangerous, perhaps is the most dangerous quadrant to be in right now. So for example, a diversified bond portfolio, according to my calculations, has an expected return of about 4% and an expected volatility of about 4%. If you think about it, you're risking 4% to make at best 4%. Whereas if you really want to protect your portfolio, you should simply just be in cash where both the expected return and the expected variance is 0%. For my own account, I don't see the sense of risking 4% to protect an investment where the downside is equally at 4%. So right now, I, and hopefully the market at some point will follow me, are trying to find investments that remain in quadrant 2. I think REITs right now offer extremely attractive risk-return characteristics, particularly if interest rates remain low. And I will admit that from my own account, I do believe that high-cap equities, particularly in the United States, remain an attractive investment opportunity between here and the end of the year. Thank you. For more information, please consult the CGA website and the CQF website.